So the first thing I want to do is I want to start off with a little bit of a mind game to help you understand where I'm coming from. So if you imagine that there's all this big circle of information and knowledge out there in the world, and then we imagine that, well, of course we don't imagine this, there is a slice of this that we actually know about, right? And then there's a whole lot of things we don't know about, obviously. But a lot of times when we come to educational stuff, or we're trying to improve ourselves, or we're trying to move forward with some idea, uh, there's the things I know, and then what I know that I need to add to my knowledge. And so there's the things I know I don't know. And so this workshop might fall into that. You know, there's things you need to know about in investing, and you kind of think they're going to, you need a technique, a tip, an idea about how to improve your understanding about things that you already know. So now the stuff you don't know could be real serious, right? And we really recognize that if we just think about it for a second. If there was some sort of disease symptom that if I'd known what that was a signal for, but I didn't, and it was serious or fatal, well, that would be terrible, right? That would be a thing I didn't know that got me. Or if I didn't fulfill some important responsibility, I wasn't aware that was something I needed to do. And in modern life, there's a lot of complexity, and so sometimes we just get surprised by something that we needed to address, and we thought that was somebody else's responsibility, or that what it hadn't been a problem before, and so it surprised us. Now the other part of that is, what if there's something down there in that we didn't know, that could help us really accomplish more than would have been possible from where we started? Well, that'd be a shame too. So now here's another problem, and this is going to come up today. Okay, the problem is that those things in that area of I didn't know can challenge what we already believe. And so this creates this, oh, wait a minute, now I already had this, I thought I understood this, and now this is contradictory to it. And so, we resist, oftentimes we resist that. And the older we get, the more we resist it, because, we sort of, I've been doing this for years, and now you're telling me it ain't right. Well, I don't know, I'm not receptive to that at all. What am I, a fool that I've been doing it the wrong way or whatever? Right. So there's a lot of resistance to some kinds of new information. So what I want you to do is be open-minded about what you're going to hear today. Now, let me tell you where I'm coming from. So, I'm an estate planning attorney for years. So I was in the Army for 20 years. I retired from the Army. I went to law school. And then after law school, first I went to work for Arthur Andersen, the big accounting firm, for 2 years. And then I started the law firm, and I've been helping people with their estate planning for more than 25 years. And so I wasn't doing their financial planning. I was doing their estate planning. And so as part of that estate planning, I would have an idea when they initially came in about what assets they had and the size of their estate. And then as time went by, they would come back at different points for amendments, for a restatement of their trust, maybe for questions about new assets or how to handle a certain asset that they had. And then if someone became disabled or passed away, they would come back and see me, and I would get these snapshots of how their life savings, how well it was handled over that period of time. And here is the sad truth. My estate planning families fall into two classes with respect to their life savings: mediocre results and terrible results. And I know that when I'm talking to people, they say, well, that's not going to be me, but I'm sorry. That's the result. Mediocre or terrible. Well, that's awful. I mean, that's just like, oh my goodness gracious. To me, that's just appalling, especially if there's an alternative to this. So now I'm not going to take you guys through this because y'all are, uh, Ms. Vu, I thought you're younger, and so you're more worried about saving for your own retirement and dealing with your own financial situations. So I'm going to skip those slides. But what I can say is that you have a tremendous opportunity to, if you could master this investment game, to grow your life savings, to realize your goals and your dreams, and to take care of your family. Okay. Now, let me tell you a little bit about my investing journey. So, first thing, let me just mention when I'm trying to contrast here. You can watch the TV on Fox Business News or any of the business channels, and you can read the Wall Street Journal, and you could buy financial magazines, or you just listen to the radio and hear the ads on there, ads for gold, ads for crypto, ads for Robinhood, all this talk about people making $1 billion. So all about you is this presumably opportunities for you to become wealthy by investing in different aspects of the stock market. It's a constant call for you to make money, especially in this long bull market. Now, at some point, the market's going to crash, and then everybody's going to run for safety. And Wall Street's got all kinds of safety stuff. So if you are wanting to not be left behind and get in on the cryptocurrency and all that sort of stuff, boy, they got stuff for you. And when the market crashes, they got stuff for you. It's a gigantic sales operation. Okay. And unfortunately, it doesn't work for clients. Now, and I'll show you why as we go on through this. Okay, so I was essentially drafted into the Army, and then I never got out after that. But anyway, I was drafted into the Army during the Vietnam period. And in 1970, I was commissioned as a second lieutenant, and in 1970-71, I began my Army career as a second lieutenant. At any rate, I was always interested in investing, and so as soon as I had any money, that was what I did in my spare time, or part of my spare time was to look at the stock market, to read financial stuff, because I didn't have very much money and I wanted to make a lot of money, and I figured I was a smart guy, just like you guys are smart guys, and you figure out how to do this and do it right. And once you mastered that, you could make a lot of money in the stock market. So I wanted to learn as fast as possible. I wanted to get into the game. And so from 1971 to 1992, I was all in on that. Whatever, if it was options, or if it was some expert in picking stocks, or if it was a magazine that said these mutual funds, I was all in on all of that. So that was 20 years, right? 20 years of fascinated with the stock market, busy with it. Now, somewhere around this time, because I retired in 1989, when I actually took stock of what I'd achieved, which I didn't like much doing, because what you really like to do when you're investing in the stock market is you just remember your winners. You don't want to remember your losers. We have sort of selective memory. But anyway, when I did a tally up at some point there when I was retiring, and I realized that I hadn't made much money. I mean, most of the money that we had was because we'd saved money, and that the returns I'd gotten weren't really very good. But I was undaunted. I was still ready to go. Well, anyway, when I got out of law school in 1992, I took a job at Arthur Andersen here in Houston. That's how come we ended up in Houston. I passed the CPA exam, and you can't be a CPA unless you work for a CPA. So I went to work for Arthur Andersen. And here's what happened. Okay. When I went to work at Arthur Andersen, I was in the tax department, and also it was where they advised clients on investing. They didn't actually handle the investments, but they would advise people and they would refer them to others. And so in 1992, Arthur Andersen, the big accounting firm, had a series of workshops, and the question was, should we change what we're telling clients to do? And, or put another way, what advice should we give to our clients? And keep in mind, attorneys, CPAs are fiduciaries. That means they're supposed to work their recommendations are supposed to be in the best interest of their clients. Now, just, typical people that work in investing are not fiduciaries. The people at Vanguard or Fidelity or Merrill Lynch or Edward Jones or Raymond James, you name it, they're not fiduciaries, and those companies don't want them to be fiduciaries because it increases their legal liability. Okay. Well, anyway, so that's why Arthur Andersen wanted to make sure they were going to give the right advice. So why were they having these workshops? It was because Harry Markowitz and a guy named French had won the Nobel Prize for what was then described as modern portfolio theory in 1990. And this went against what most of what Wall Street was doing. So anyway, we had these series of workshops. It was very, very good, and it was very persuasive. In spite of the fact that it was very persuasive, I still loved all the other stuff I was doing. So what I did is I put half of my assets into what I took these ideas from Modern Portfolio, which was essentially to invest in index funds. And I just kept doing what I was doing with the other part. So I had two contrary ideas in my head. Okay. And so then, remember, I started the law firm, and so now I'm starting to see clients and how they're handling their investments. Now, notice that in 1992 to 2003, that's when I was straddling these two opposing investing systems. The one that Markowitz and the academics and the Nobel Prizes pointed to, and the one that Wall Street pointed to. So, and after the crash in 2002, depending on how old you are, the crash depending on if you were loaded up on tech stocks, that crash started in 2000. 2001, 2, and 3. 2001, 2, and 3. That crash, and many people just got killed. That was when Enron went bust. That's when WorldCom went bust. That's when many of the high flyers from the years just previous to this just went to nothing, and people just got ruined in that crash. Well, I was looking at these two portfolios I put together, the Wall Street version and the following Wall Street's advice, and the more my do-it-yourself academically designed one, and that was the end of it. I decided that the Wall Street role just didn't. The academics were right; it didn't work. Okay, and so then from 2003 to 2002, for my personal assets, it was all in my do-it-yourself modern portfolio theory set up, and that meant I was trying to get the lowest expenses, and so I invested using a variety of Vanguard index funds. That's how that was. Now, you guys remember 2008, and 2008 was one of the worst crashes since the Great Depression. It really started in 2007. It affected not only the stock market, it affected the housing market, it affected all kinds of stuff. And if you lived through that, you remember it. And if you remember it accurately, you remember it was a terrible time. Everybody was singing the blues just about during that period. Well, my estate planning clients, again, I'm still not an investment advisor or coach for these people, but I'm watching my estate planning clients, and they lost a ton of money. They lost hope. They sold out. They took terrific losses in this. It was just a wreck, a big wreck. And many people are still bitter about it. It changed the future of their retirement for their family, depending on how they responded to that 2008 year. So after that, I decided I should try to help these people use the academic use the system that's got some science to it, that's got some numbers to it. Well, you got to get licensed, you got to do all kinds of stuff, but also if you're going to do this, you have to find somebody to work with that is actually involved with implementing these systems. Well, Wall Street's not interested in this at all. Okay. I mean, they'll give lip service to it, but it is not part of their business model. And that's why you have probably never heard about this on the basis that we're going to talk about today. So anyway, I finally ran into Mark Matson of Matson Money, and he is completely committed to this. And he first heard about this in the same period when I heard about it in 1991, 1992. Anyway, so that's so I work with Mark Matson of Matson Money to create these academically designed portfolios. And the reason I switched to Mark is that when I compared the portfolios I was running with his, after all expenses, his did better than mine over long periods of time. So that convinced me. So, okay, with that, let's get into some of this. So, Ms. Thornton, welcome. Glad to have you aboard. And you're going to get most of this, so I hope it'll be real helpful to you. So this is called Separating the Myths from the Truth, the Story of Investing. And so as we start out, here's what we're trying to prove or talk about. There are 4 destructive myths about investing. Okay? There are 3 academic theories that dispel these myths. And there's an academic application. In other words, out of these Nobel Prize winning insights and the research that supported those give guidelines for how you would build a winning portfolio. It's just nobody does it. Okay? And that if you did that, you could get peace of mind. Imagine that. So let's talk about these 4 myths of investing. So a myth is a traditional story, especially one concerning the early history of a people or explaining a natural or social phenomenon, and typically involving supernatural beings or events. So what about common investing myths? What are those? So one is, we're going to talk about, is myth 1 is stock picking, which I did for years and years. And another one is relying on the track records of people who have done, investment managers, mutual fund managers that have done great in the past. I've done that a lot. I bet you have too. Myth 3 is time in the market. Well, of course you're going to time the market. If the market goes down, well, you sell, and then when it's starting back up, you buy it again, right? Everybody does that. That's just a winning proposition. And then there's cost of investing that people don't seem to understand. So let's go on to the first one, stock picking. Okay, stock picking is based on the idea that you can pick stocks based on a belief that they will do well in the future and that you could be successful at that. So what's the myth? So think about that for a second. This is what everybody does. It's all, that's the fun of it. You say, well, golly, I'm going to invest in Apple. Apple's got a great story. And then when I go to the golf course or I'm talking to people, I say, well, yeah, I got some Apple. I'll make some money on that. It's pretty good. And also when we buy the stock, it's like buying a lottery ticket because you say, if this goes well, it's going to be great. It's going to be great. I'll make a lot of money. So we can go. So every time, and if it doesn't pay off, when we say, well, that one's it's not so good, or we might hold it, thinking, well, it'll come back. Especially if it goes down, we might hold it a long time. It'll come back. I don't want to take a loss. But we can always just pick whatever's hot now, and so most people just pick what's hot now. Okay, so the myth is that investment advisors can consistently and predictably add value by picking stock. So you say, well, even though I'm not, I don't know that much about stock market or stocks, but I have a great advisor at Merrill Lynch, or I bought this mutual fund and it's famous. It's a 5-star fund, and this guy's made a ton of money over the last few years, and so I'm buying it because then I'll make a ton of money over the future years. Okay, so the whole idea of this is that people can pick stocks consistently. They're going to go up. Okay, so this slide shows this is about the history of mutual funds, actively of mutual funds. And so the first one was in 1923. And then you can see as the years went by, more and more and more were added. You got the number of funds and then the new funds that came into being. And so for a long time, it was very few mutual funds were added. And then in these last columns, I mean, hundreds or thousands of funds were added in a given year to this. So what are the total number of funds opened as of 2020? 32,000. That is more mutual funds investing in stocks and other financial devices than there are stocks to invest in the U.S. Total number born over this period from 1923, 68,000. So right off of the bat, apparently not all of these funds are successful, right? So how many were killed? More have been killed than exist. And there's a lot of them that exist. What is going on here? Because if somebody can pick stocks, he's going to be selected for one of these mutual funds because he's an expert. He's got the credentials. Well, why don't they all make money? Why would they kill them? Okay, the worst 200 dead mutual funds had a cumulative loss of 86,000 of 86%. So these people not only didn't increase the value of your mutual fund, they killed you if you were invested. Okay, so let me show you this. Now, if the little pictures are on the side and they're covering this stuff up, keep in mind, you can put your mouse on the top bar and you can move that around and get it out of the way. You can also minimize it. That little one flat one on the side, you can minimize it so it doesn't interfere with being able to look at the chart. Okay, so this is very interesting. Follow it with me, please. It goes from 1972 to 2020. Okay, so how long is that? Well, it's almost 50 years, right? Almost 50 years. And on the left-hand side is the value of the money. And so what we're going to do is we're going to start out with $100,000. And then what we're going to do is each year, this is a thought game. We're going to invest. We're going to receive on our $100,000 investment the average return of the average U.S. mutual fund that's invested in stocks. Okay, we're going to receive the average. So whatever the average return of equity mutual funds in that year was, we're going to get credit for that. Okay, and so at the end of 2020, the value of your 100,000 is $4.9 million. You say, well, that's a lot of money. I did really good. Well, you should always ask yourself, compared to what? Compared to what? Well, the S&P 500, if you just bought that, you'd have $10 million. If you bought the total stock market index. When I say the S&P 500, I'm talking about these have been. In this case, the S&P 500 is an asset class. It's been studied by the academics. And so the S&P 500 is 10 million. And this CRSP, that's the total stock market index, U.S. stock market index. And that would have been 11 million over that period. So what is the takeaway? The funds that were managed by a human being who thought he was brilliant at picking stocks did not do as well as just holding. In the case of the S&P, it's the 500 largest corporations in America in any given 6-month period. Usually every 6 months they check, and if some company has went bankrupt, went bust, fell out, whatever, then it falls out, and whatever company that's now part of the S&P, that's part of that 500, goes into that index. And so all this is holding the 500 largest corporations in America over this long period of time. Okay, same thing for the CRSP, the total stock market. It's the same idea. Okay, so what was the loss to active management? In other words, where people were picking stocks, the difference in return over a long period of time was millions and millions of dollars. Now, if you're picking stocks yourself, what's the chances you're going to do as well as the investment managers, the people picking stocks? So something is wrong here with this whole idea of picking stocks, but it's hard to put your finger on it if you haven't thought about this, or if you don't have the right information. Okay, here's another one that I want to show you. Same thing, 72, 2020. We start with $100,000. And this is not just equity mutual funds. This is all mutual funds. There's mutual funds that invest in bonds and gold and all kinds of stuff. So if you invest in the average of all mutual funds and you got their return each year for this nearly 50 years, you'd have $2.3 million. If you had a fund that was invested using the academic principles and was 70, this conservative one is 75% bonds or fixed income, only 25% in stock, so it's very stable, you would have gotten 4.2 million without picking stocks, just using asset classes. And if you'd had an academically designed portfolio with 50%, that's the moderate, is 50% stocks, then 9.3. And if you had an academically designed portfolio using these asset classes with 75% stock, you'd have 18 million. And if you had 95% stock, you'd have 27 million. Okay, so having somebody pick the investments does not seem to be a winning proposition. Okay, anybody got any questions or thoughts on this for me? This is something you got to take seriously, what I just said. And I'm going to tell you why in a minute. I'll show you what the academic principle was that came out of this. But the point is, if you have stock, if you have picked individual stocks, what's the chances you're going to beat these indexes? I mean, you're not a Wall Street guy or lady. What's the chances you're going to win at this proposition? If the Wall Street people can't beat the dadgum indexes, something is amiss here. This whole idea of picking stocks must not work, or we don't understand it. What is going on? Anyway, let's leave that hanging. The second myth is track record investing. And this is the use of performance history to determine the best investments for the future. Okay, I've been fooled by this, and you have been fooled by this if you've ever invested in a mutual fund. Okay, so the idea is that there's these really smart guys on Wall Street, and they have gotten tremendous returns over the last period. And you heard about this mutual fund, and the guy's he's on the radio, he's on TV, he's a star because his fund has done exceptionally well over the last few years. And then Morningstar shows that's a 5-star fund. And you look at your other mutual funds, and some of them are 3-star funds. So you sell yours and you buy this 5-star mutual fund. Now, I've done that over and over again in my earlier days. And you are probably doing it now. Or if you're not doing it, maybe you're doing it in conjunction with your investment manager who's picking the mutual funds that have done best in the past. Okay. The myth is that finding funds that did well in the past is a reliable method of indicating which funds will do well in the future. And everybody goes for this because it went up in the past. Well, I'm just going to get on that bandwagon. I'm going to follow this really smart guy, and I'm going to make a ton of money in the future. Okay? So let me show you some stuff. So let's say that we have an investment club, the 4 of us, right? And we have just, it's late 2010 or 2011. And we're just coming out of the dadgum 2008 crash. And we're all, our portfolios are all messed up. We're not sure what to do. And so one of us comes into this meeting and says, listen, I got an idea. I've been researching this Morningstar data, and the top 30 U.S. equity funds over the last 10 years got 15.83% a year, in spite of all these troubles that the tech crash and the 2008 crash. These guys have got it together. 15% a year. How fast does your money double? And if you make almost 16% a year, what is that? It goes into it's in between 4 and 5 years, your money would double. Holy cow! That is fabulous. And look how look at the next line. The average mutual fund, the average equity fund, U.S. mutual fund, returned during that same period 2.63%. The S&P didn't even make a 1.5% a year. The total stock market made 2.55%. So the top funds are totally superior. So let's buy those. Let's quit messing around. Let's buy this. This is a smart thing to do. Now this is how this is a humongous approach to investing used by almost everything. Okay, so how did this go? Okay. Over the next 10 years, we meet, and let's say we meet in early this year, 2021, and we review the bidding on how this went. And what do we find? Well, our funds, they did okay. They got 6% a year. It wasn't 15. So your money doubles in what, about 6 goes into 72, 12 times, maybe 12 years. But the average mutual fund got 11%. The S&P got almost 14. The total stock market got 14. And I got 6 a year. Holy cow. Now you might say, hey, I cherry picked this. I picked something. No. Listen, we could do this all day long. This is another one. I don't know. So let's just play this out for a second. So let's say in 2016, you and I are sitting down together, our little club here, and I say, hey, listen, those 10-year funds that we selected, that 10-year thing, they're not doing that well. Let's take some money and look at 5-year performance data. Maybe that's where the sweet spot is, that if it went up over the last 5 years, it's going to go up over the next 5 years. And so we look at the top 30 U.S. equity funds for 2011 to 2015. They did 31% a year. Holy cow, your money doubles between 2 and 3 years. Good grief. And the average mutual fund during that period did 9, which is darn fine, but it's nowhere near 31. These mutual fund managers, the ones that got 31.5%, they know what they're doing. We need to get with us. And they smoked that S&P, and they smoked the total stock market index. So they are the ones. Okay, so then 5 years passed, and we look at how it went. They got 9. The average fund beat them. The S&P beat them like a drum. The total stock market beat them. Okay, has anybody got some thoughts on this? Are you as appalled by this? Now, again, this is not cherry picking. Here's the conclusion. A manager's ability to pick stocks in the past has little to no correlation with his or her ability to do so consistently in the future. And yet this is one of the biggest selling deals on Wall Street. It's the Morningstar ratings of mutual funds. And whatever mutual fund has done great over the last year, 2, 3, 4, 5, is swamped with money. Investors pour money into it because of this expectation that if it went up in the past, it would go up in the future. And yet there's no correlation. No correlation. Okay, so tell me, has anybody bought a mutual fund? Or you guys? I kind of need to. Ms. Thornton, do you own mutual funds? Or Ms. Vu?
Yes, I have mutual funds.
Were you aware of this? That there's no correlation between prior returns and the current and future returns?
No, not really.
Right. I mean, it goes against our common sense. We figure if some manager knows how to pick stocks in the past, well, surely that's going to persist in the future. You know, if you go to a good Mexican restaurant that you always go to and they always have good food and you like it, you figure the next time you go to them, they'll have good Mexican food the next time. Well, wait a minute. This isn't how this works. Holy cow. I've been fooled by this so many times. You should just be so furious. Boy, if you believe what I say, you should just be mad all over. Okay? You should be mad about all those mutual fund, the managers that are going to pick stocks for you too. And if you're picking stocks, I hope you're having second thoughts. Okay, market timing. We're going to talk about why these things are as they are in a minute. In other words, what the Nobel Prize insights were on this. Okay, so another one is market timing. Okay, everybody times the market. Of course you time the market. If market is going up, you buy. And then if it goes down, you sell. And then when it starts back up, you can buy it again. And so we're going to get in and out of the market. Also, certain assets do better in certain periods. And so we want to change, we want to respond to that. So we want to own more stocks when the market's going to go up, and we're going to own more bonds when we think it's going to go down, and so forth. So there's all kinds of things we can do to tweak our investment portfolio by market timing. Right? Everybody does. Certainly. And especially, if there's a crash coming on, well, you got to get out of the way. So we're going to sell our stuff in that case. Okay. So what's the myth? Money managers are able to utilize market timing to effectively predict up and down markets. Now, if you listen to anything on the financial news, it's all about timing the market, picking stocks, brilliant managers, money managers. All the things I've been talking about, that's all they talk about all day long. Okay, so is there truth in this that we need to consider market timing as one of our strategies to maximize our returns and to keep from taking losses, right? So this study, this is called Dalbar Research Study, and this is a big deal. It's in Boston. The results are published in the Wall Street Journal every year. It's been going on for years and years. And so they assess in one of their studies the effectiveness of the average investor with stocks and equity mutual funds. So here's another appalling number here. So from 1991 to 2020, which is 30 years, the average investor in equity funds got 6%. Inflation rate's 2%. And the S&P 500 got 10. So how come the average investor got less than the S&P 500 index? And the answer is, in part, that they were getting in and out of the market. Okay, so let me show you this. This kind of helps you to see how critical or how useless, it's probably a better way to put it, is market timing. So so let me help you with this chart. It says why market timing doesn't work. And then this thing goes from April 1, 2001 to March 31st, 2021. So it's 20 years, a little over 20 years. It's greater than 5,000 trading days. Now, on the left-hand side of this is the S&P 500. And we keep using this just because everybody's heard of it. And it's a well-known indicator of market action. At any rate, so the S&P 500, and like I already explained to you, it's the 500 largest stocks in America. And every 6 months, they adjust it. One company may have fallen out and they'll add another company. It's not like they're changing very many. They're just keeping it the largest 500 all the time. Okay, so they're not buying and selling. They don't care whether the company's good, bad, or indifferent. If it falls out of the S&P 500 or it gets bigger and goes into that group, it's just the 500. And it doesn't care whether that one of those is going to crash next week, next month, next year. It's just the 500 largest corporations in America, and they make sure every 6 months they check it to keep it that way. Okay. So what this is saying is, if you invested $10,000 in that S&P 500 index, at the end of that time, you'd have $50,839. In other words, it would have quintupled during that period. And then it says that if you miss the top 5 trading days, you'd have 32,000. If you missed the top 25 trading days, you see that over here on the right-hand side, the top 25, you'd have 11,000. If you missed the top 30 days, you wouldn't have your 10,000. You would have lost money over that 30. So why is that? The reason is that what happens is like in 2008, the stock market started out in 2007. It finally hit bottom in February of 2009, and during that period, the news just got worse and worse and worse and worse. And the S&P 500 declined by 50% from the fall of 2007 until February 2009, and most people bailed out during that period. Right? Well, and then after all during 2009 to 10, people were still worried about it, so they were scared to get back in the market. Well, beginning in February 2009, it came off that bottom like a rocket. And so you needed to be in the market during that whole period. If you weren't, that's what they're talking about. You miss out on the big movement days, and it diminishes your investment return dramatically. And these national numbers from Dalbar show this affects most investors. How sad. It's another way to get mediocre, terrible results. Okay. So Charles D. Ellis is the guy he's a professor. He's written a jillion books on investing. He's considered one of the heavy hitters in this business. And he says the evidence on investment managers' success with market timing is impressive and overwhelmingly negative. Okay, the cost of investing. So whenever I'm working with clients, almost the first question they ask me is, "Oh, well, what does it cost to invest with you?" And my initial response with people is, "Well, what are you paying now?" And I'm amazed at the answers I get. Now, don't get me wrong. We want to be, in my case, if you're investing with us, we want to be completely transparent about expenses. But even though people ask about that as if that was on top of their mind, the most important thing, when I ask them what they're paying, many of them don't seem to have a clue. I had a man that I was talking to, and he had a managed stock account at Merrill Lynch. And I asked him if he paid any fees, and he said no. Now, I don't know about you guys, but I was not aware that Merrill Lynch is owned by Bank of America is a charity. That it was really a surprise to me. So obviously something was amiss in his understanding of how Wall Street works. They are not charitable enterprises, right? Now, so at any rate, one of the things that people miss out on, and this is particularly the case where people have a managed stock portfolio with one of the, many of my clients have been in the position where they have a managed stock portfolio at Merrill Lynch or Oppenheimer or Fidelity or someplace, and they pay a fee for that every year that they can find out about. But also inside that their managed stock account, Merrill Lynch or whoever it is buying and selling, and they make money on those trades, and the clients don't understand what's going on. So the myth is, if you don't see it, it don't hurt you, but that's not really the case. So there's this bid-ask spread. So if you sell a stock for $50, you don't get $50. You get $49.50 or whatever the spread is. And then many people do not seem to understand. There's load funds. I mean, a lot of people have heard of that there are load funds and no load funds. And when they hear, apparently when people are no load, they don't think there's any expenses in them. This is not right. All mutual funds have expenses, some very small and some much larger, and so they have internal expenses inside the mutual fund. And so in many cases we have clients and they're paying Merrill Lynch or somebody a fee for their portfolio, and that portfolio holds a bunch of mutual funds, and the mutual funds all have fees in them. Anyway, this is the example. If you sell that $50 stock, you're not going to get $50. You're going to get $49.50. And if that stock doesn't do well in the future, well, then that just diminished your portfolio. In any event, it diminished your portfolio by $50. And of course, Merrill Lynch is interested in making this money, and so they have a reason to buy and sell the stocks. Right? But what have we been learning so far? That it doesn't make much sense to buy and sell stock. No. This just costs you, and there isn't any point. We'll come to why that's true in just a second. Okay. Now, also, the big stocks like Amazon and stuff, they typically have relatively small fees spread. But if you're investing in internationals and small stock and other things that need to be in your portfolio, there's a much bigger spread. So. This can create a significant expense. Many actively managed mutual funds buy and sell. So the stocks they start with at the first of the year, they will sell all or nearly all of them by the end of the year and buy other ones. And so you're paying these transaction costs both ways on the sale, and then that goes into the purchase price. So the key question, this is Charles Ellis again, the key question of the new rules of the game is this: how much better must the active manager be to at least recover the costs of active management? And the answer is daunting. Remember, the average mutual fund can't beat the index. Or put another way, the actual studies show that something like 85 to 90% of actively managed mutual funds, that's where the manager of the mutual fund is picking stocks. He's trying to, he's selecting the good ones and he's getting rid of the bad ones. And so he's going to beat the index that's closest. 85 to 90% of the active managed mutual funds cannot beat the index. Part of the reason is their fees are high. Okay, then the index funds, the asset class funds. Okay, so far we've talked about the myths: stock selection, track record investing, market timing, and costs of investing. So all the things that we've been talking about are the everyday stuff at Wall Street. It's what makes Wall Street go around. Getting you to buy that stock that's going to go up in the future. Get that mutual fund that's done so great over the last little bit. Making sure that we need to time the market. We're going to have an election. We're going to have inflation. So we need to do this or that. If the market crashes, we need to get out and change, buy an annuity or something. Constantly need to follow what's going on and adjust. That's what we want to do. So what's the contrary notion? What's going on here? So Matson's using a method investment approach based on 50 years of sound academic investing research and accepted financial theories. Now, when I first started talking about this, I told you that when I worked for Arthur Andersen in 1992, they had a series of workshops for people that were in the tax department and advising people on investing, on what was the right advice. And the reason for that was that Harry Markowitz had won the Nobel Prize for modern portfolio theory in 1990. Okay. So when we're talking about this, we're not talking about some little guy's notion about how to invest in it. We're talking about the best academic research and empirical studies that bear this out. Okay. So what we're trying to do is have a disciplined approach that seeks to capture market returns while managing the volatility for you so you can sleep at night. You can pick how much punishment you're going to take in the next 2008 or the next crash. So what are the components? One's something called the efficient market hypothesis. Second one's called modern portfolio theory. And the third one's called the three-factor model. Okay? So we're going to go into this for a second. So Harry Markowitz, this is Harry Markowitz. Markowitz, incidentally, is on Matson's academic board. Now, would he be on Matson's academic board if he didn't think Matson was using the best ideas in finance? No. Merton Miller was one of the involved in that Nobel Prize in 1990. And then Rex Sinquefield has been a guy that's been on the edges of this all the way along. And he actually started the largest mutual fund company you've never heard of, called Dimensional Fund Advisors, which implements these scientific ideas so that you and I can invest in these asset classes that make sense, academic sense. Okay, and you, just in case, so you say, well, that's 1990. What is this? Just stopped right in 1990? No. Actually, Fama was releasing academic stuff way back in the 50s and 60s, and he won the Nobel Prize in 2013. So, and Matson has talked with him over the years and bounces ideas off of him. He has an interview that he recorded with Eugene Fama. And then Kenneth French has been involved in this. Okay, so what is the efficient market hypothesis? It says in a free market, at any point in time, the actual price of a security, a stock, will be a good estimate of its intrinsic value. Now you say, well, what does that mean? What does that mean? Notice that this is from Eugene Fama. The title of this was Random Walks in Stock Market Prices. So what does this mean to you? Okay, what it's saying is that at any given time, well, okay, let me say this. The idea of picking stocks, which I did for years, and you guys may have been involved with, or if you've got an investment advisor, he's been involved in. He's a stock picker, or he's got a research department that does pick stocks. The idea is that at some point that you would look at Exxon, and you're doing your study, and you decide that Exxon is underpriced. In other words, the market doesn't have the right price on Exxon today. It should be higher price. And so you buy Exxon because your research shows that in the future it'll be worth more. Or Apple or Amazon or whatever it is that we're talking about. In other words, I'm doing research and I have figured out in my little mind that in the future this thing's going to be worth more than it is today, and therefore I'm buying it. Or I go the other way. I'm looking at the stock and it's overpriced, and we need to get out of that one, and we need to buy these ones that are underpriced. So that's a whole strategy. It's one of the things that was used by stock pickers and still used by stock pickers. And there's whole books about this. There's studies about it. You can subscribe to services about this. So what does this little statement say? It says that at any given time, the value of the stock is the best. That's the value. It's not underpriced or overpriced. That's the value. And not only that, what's going to affect its value in the future is something that hasn't occurred yet. And it could be anything. Okay? So the insight that somebody has about this, it can't be accurate, because what's actually going to affect its value is something that hasn't happened yet. Now the guy might say, well, I'm going to anticipate this and all. But here's the rub. Listen to this. Mathematically, from this day, when you and I look at the stock going forward, its value over any period in the future is random. It might be up, might be down, might be sideways. It's random. The path is random, mathematical. That means there's no point in picking stocks. That's not where the action is. No point. It means there's no point in having a portfolio of miscellaneous stocks because there's no math that could tell you what they're going to do in the future. It's just all by guess and by golly. And that's what my clients have, is by guess and by golly portfolios. That's what Merrill Lynch and that's what Edward Jones are going to put together for you, to by guess and by golly. Okay? Sorry about that. That's the sad truth of that. Okay. So you could believe that free markets. Oh, let me back up. Why is this the case? This isn't true in lots of areas of life. Like I said, if you have a good Mexican restaurant, it'll probably be good tomorrow, right? So that's a good estimate. But why didn't it work like that in the stock market? The reason is these gigantic capital markets. It also doesn't work this way in the real estate market because the market's not that big, and certain players can have information that's actually valuable about potential value in the future. But in these gigantic capital markets with millions of players and millions of transactions, all the information available at any time is already factored in the stock, okay? Including people's emotional interest in it. It's all factored in the stock. And what happens in the future is going to be based on something that nobody knows what it is. And finally, the math of it is that the future values random. Could be up, could be down, could be sideways. The expert's guess is just as good as yours. Okay. Well, why? You don't want to build any. I mean, what? There's nothing there to build anything on. It's hopeless. Okay. Okay. So one view is that free markets fail and that it can't price the goods and services efficiently, or the stocks efficiently. And so then it would be possible for your stockbroker to pick stocks, or for this guru in Wall Street to pick stocks, or for you to pick stocks, and that you could make money doing that. And underpriced or overvalued markets can be forecasted and predicted. This is a big game on Wall Street. And plus, it keeps you interested and excited about it, and interests you in buying stuff or selling stuff, which is Wall Street's game. And the managers seek to increase returns and avoid losses by taking advantage of stock market or mispricing. That's what they're doing. Okay. And so if you believe that, then you just stay and do what you've been doing. So it's fun. In some way, it's like gambling, and you can dream that you're going to make a lot of money. It's just not likely to work. Okay, so the other idea is that free markets work, and in that case, the market actually is selecting the correct price today based on supply and demand. And the information in these giant markets is already factored into it, and only new and unknowable stuff is going to change it in the future. So the randomness of the market makes it impossible for any individual or entity to consistently predict market movements and capture additional returns unrelated to risk. In other words, no point. Okay, people of this view should utilize free market investment strategies, or put another way, we should go back to the Nobel Prize winning principles and the academic research and the empirical studies that show, hey, this is how you do it. I said Wall Street's not interested in it because it's not part of their business model. Their business model is to get you to buy and sell stuff. Okay, so what you believe about this is going to dictate what you want to do. And so one of them is free markets work. Well, then we want to use the best thinking about how they work and use these principles to guide our behavior. And the other way, they fail, and we just keep doing our stock picking, market timing, and track record investment. But we already know from the studies it doesn't work, so you should be turning sour on that notion, hopefully, in this. Okay, so second component, modern portfolio theory and diversification works. And this goes back to the Nobel Prizes and all these academics that worked on this stuff. So Markowitz's okay, so one of Markowitz's insights was this. Okay. So you guys ready for this? It's the efficient frontier. And so I'm going to make it really easy to understand. This line that goes across the page, that is the highest return for the lowest risk, lowest volatility. In other words, how much it would move in a crash, how much down would move in a crash. And this is based on returns. It's 44 years. So I think it goes back to 73, I guess. Anyway, it's 44 years of returns. And so on the left side, so let me just acquaint you with this diagram so you can see what's going on here. On the left side, it shows 6% annual return, 8% annual return, 10% annual return, 12% annual return. See, that's on the left-hand side. And then on the bottom is 6, 8, 10, 12, 14, 16, 18. That is standard deviation, which doesn't mean much to you, but it means risk. It means how much volatility, right? And for practical people, it means how much downside risk we have. Remember, I told you that from 2007 to 2009, the S&P 500 went down by 50%. If you had $1 million in February 2009, you'd have 500. Most people cannot cope with that. You do not want that kind of risk, okay? So we got to figure out how to get the risk so you can tolerate it in these portfolios. Now, what was his insight? So what was the point? We've drawn a line, and this is investment mixes that get the highest return for the lowest risk, lowest volatility. And you see, if you look at this dot for the S&P 500, that it has, this is high risk. I already told you it went down 50% in that period of 2008. It's got high volatility. It's almost up to 18 on volatility. And its return over this 44-year period was a little over 10%. So what's wrong with that? Well, everything is wrong with that. And listen, most of you guys, if you've got a stock portfolio, you may not have S&P 500, but you kind of have your own quirky version of it. Because in this sense, the stocks that clients typically own when we analyze them, they're stocks that are part of this U.S. large. They're the ones everybody's heard of, so you're comfortable with it and talk about it and everything. They're part of the S&P 500. So you've got your own quirky version of the S&P 500, which is actually riskier than the S&P 500. But they're all in that category of U.S. large companies. So what's wrong with this? What is wrong with this, guys? Okay, if we didn't like that risk of 50% drop in 2008, we could have moved over here. See if you move sideways. And in this portfolio, let's just go to this this next dot over right here. That's the moderate portfolio. That's 50% fixed income and 50% stock. And the volatility on that is much, much less. In other words, your account would have just gone down much, much less than 50%. You might have been able to bear up for that decline, and you would have gotten almost the same amount of return for a fraction of the downside volatility. Holy cow. Okay, on the other hand, if you had nerves of steel, well, you just mortally messed up because you could have gotten another 2% a year with the same risk if you'd had a portfolio that was properly constructed. I mean, it's just when I say clients get terrible or mediocre results, if all the stuff you own is large U.S. companies, the best you could ever do is mediocre. And if you keep buying and selling, you can do a whole lot worse than mediocre. You can get terrible. Okay. So what are the determinants of portfolio performance? Well, it's not market timing. It's not other factors. It's not stock selection. It's holding the assets, asset allocation. Okay. Now, here's something I want to show you. This is the huge insight that Markowitz said. How do you create, and this is for us, how do you create a portfolio with higher expected returns and lower volatility. How do you do that? Well, what you want to do is you want to find desirable asset classes that have got some math connected to them about their possibilities in this world. We'll talk about that in just a second. Because remember, we haven't had any math so far. Nobody can tell us how we can't guess up, we can't figure out how to get a particular return or what to expect from our stock pick or our mutual fund in the future. Once we buy it, it moves out in the future and it's up, down, sideways, whatever. Random, right? And then if we're buying and selling, we've added more troubles to this whole process. Okay? So how do we figure this out? So here's what Markowitz said. He said what you want to do is you want to hold investment A that moves in this cycle, and then what you want to do is you want to have another desirable asset class that does not move in the same direction at the same time. They don't have to be opposite. This would be almost opposite, but they shouldn't. The idea is if the less they correlate, the less downward volatility you have in your portfolio. So just in this example, if you take where these arrows are pointed here on investment A and investment B, when you open your account statement, it would average out these two. And so it didn't go down as much as investment B went down, and it didn't go up as much as investment A did. So that's what we mean by reducing the volatility. So from the standpoint of having huge changes in your portfolio, this is the way to smooth it out, okay? Now, the other part of this is very important. And it took me a while to do this, to figure this out. So let me just share it with you. If you hold these asset classes that have a expected return, here where I said that have an expected return. Most of the stuff we've been talking about before, it has no expected return. There is no math in the future. So what we're looking for is something that does have some math about future returns, and we're looking at expected return. Mathematically, you'll get the expected return of both of these assets. And so this is a way to increase your return and lower your volatility. This is the insight. This is what you want to do in your portfolio. Okay. Okay, so just here's an example of this. So let's say we had everything was in the S&P 500 index. So we got an annualized return of 10%, and the standard deviation is 16.68. And so then if we instead we made it 75% S&P and 25% large international. That's what this Europe, Asia, and the Far East is. You put internationals in there, we get almost the same return and slightly less volatility. Okay, if we instead added international small, so we had 70% S&P, 20% of international large, and 10% international small. Just for example, the return goes up 11.1 and the volatility goes down. So that's one example. Okay, so that's the idea of the efficient frontier and of how to construct a portfolio with the best chance of success. Okay. Questions? Any thoughts on that? Okie doke. So now here's another one that is, to me, just amazing. So this is the knowledge of this three-factor model has been around in papers and academic studies for a long time. And then Eugene Fama won the Nobel Prize in 2013, sort of the culmination of all these years of examination. And some advisors, some people have been implementing this for years, and it sort of got the boom certified in 2013 by the Nobel Prize. So what is it we're talking about? So the first thing to say is that the returns on the S&P 500 are vastly superior over the long term and notice we're talking about 1926 to 2020. The S&P 20 was 10% a year, and T-bills were 3.29% a year. And so the short answer is equities always beat, or these asset classes of equities always beat fixed income. Okay. So in one sense, that's not much of an insight, although every now and then I see people who prefer to have a large amount in bonds or in muni bonds or in long bonds or in junk bonds, and they think that that actually is a good way, because in certain years, bonds may do better than stocks, and so they get the idea that in this particular period it'd be great to own a lot of that. It's sort of market timing and some notion about this. But the real answer is, if you don't use equities with your financial assets, you're just going to miss out. Okay. Let's do it. You cannot be a good steward of your resources, your family's resources, if you don't use equities. Okay, now here's the size factors. So small companies are riskier than large companies, and small companies historically have provided a higher return than large companies. Okay, what I've just been telling you guys, everybody's invested in stocks that are part of the S&P 500. I mean, it's almost exclusively when we analyze people's portfolios. Okay, but what does this say? It says from 1926 until 2020, the U.S. small company, the bottom half of the stock market, that's what that CRSP 6 through 10, it's the bottom half of the stock market in size, returned 11.57%, and the S&P returned 10.28%. Now, 1.5% like that would make a big difference over a long period of time in your portfolio performance. So not having that in your portfolio means you can't get, I mean, you can get mediocre returns, right? Like I said, and you can't get great returns. Notice also that this U.S. small is highly volatile. Now, remember, that was another insight from Markowitz's efficient frontier idea, that you can combine riskier elements and reduce volatility by combining asset classes that don't move in the same direction at the same time. That's how you can include these in there without getting more volatility than you can stand. Okay, now this other one has to do with value, and so what the slide says, high book to market value stocks are riskier than low book to market stocks. So what the heck are they talking about? So just for example, a company like a utility, or maybe another obvious one would be like an Exxon or one of the big pipe companies. They have, like Exxon owns, they have assets all over the world. They have assets everywhere. They have plants, they have pipelines, they have trucks, they have stores, they have product. I mean, they have there's stuff everywhere. And so their huge revenues in proportion of those assets are, the percentage of revenue to all those assets is smaller. Whereas if you take one of these internet companies, they may only have a handful of employees and billions of dollars worth of revenue. So their assets are very small in relation to their revenue, whereas this other company is a huge company and it has a huge amount of assets. Well, the value stocks that have all these assets are riskier over the long term than the U.S. large stocks, that S&P 500 stuff. So from 1927 to 2020, notice this: the U.S. large value stocks returned almost 12%, and the S&P 10.25%. over that period. And they also have, the US large has a higher volatility. Most people don't have much of this. Okay, so that's why most people can't succeed with this investing, is because they don't even own the asset classes or stocks or equities in those asset classes that would give them the highest returns. Okay, so the academic approach is to use these insights from the Nobel Prizes and the academic studies and empirical studies that show this stuff is fact. So we want to use efficient market hypothesis, the modern portfolio theory, the three-factor model, and that's the Matson method. And here, like I told you at the beginning, I did a do-it-yourself with Vanguard. And then when I compared my results over about a dozen years, Matson beat me after all expenses. It's a great system. I don't know of anybody that's got a better system or more committed to it. Like I said, there aren't very many that are even trying this. Wall Street's not interested. It's not a moneymaker to them. Too hard to explain, and they're interested in buying and selling. That's where the money is. So we want to apply academic research to create a better portfolio. That's our goal. So let me go. I read my slide here. So Dalbar shows, remember, that the average equity investor, his annual return is 6%, and his risk or volatility in the portfolio is 17.63, and the S&P returned 10.7 and has a standard deviation of 17.3. In other words, the average equity investor has more risk with what? Only 60% of the return. It's missing 40% of the return for the same risk. I mean, holy cow, we got to do better than that if we're going to win at this game. If we care about our life savings, we got to win, right? So why don't the average investor do any better? Well, one is that they sell out every few years. That we're chasing the market. That's what everybody's doing now, loading up on the fast-moving stocks over the last few years, mostly U.S. large. Famous U.S. large stocks. That's what everybody owns. They shouldn't be in them, but that's what they are. And then they're active stock picking, right? We're picking stocks and we're timing the market. So that's what we do. So to create a diversified portfolio, here's how it would work. Instead of having 100% in the S&P 500, this is portfolio one, 100% in the S&P 500. So what do you get? Instead of, in that portfolio, we've already seen we get 10.74 from 1970 to 2020, and we have a standard deviation of 16.89. Okay, if we took that portfolio 2 and we reduced the S&P to 60%, we put in 5-year government bonds for 20% and 1-year fixed income for 20%. In other words, a 60-40 portfolio. You reduce the return, but you dramatically reduce the risk, the downward risk. Okay, the portfolio 3 has 30% S&P, 20% 5-year, 20% 1 year, so it's still 40% fixed income. But now it's got internationals, international small and international large. And so now we have a return of 9.96, and we've maintained the lower volatility. So we have lower volatility, and we've increased our return slightly. Okay, and then in portfolio 4, we reduced the S&P coverage to 7.5. We still have 40% fixed income, but now we have these other asset classes: international small, U.S. small value, U.S. large value, and the international large. And now the return is greater, or is almost equal to the S&P 500, but our risk has only risen slightly above the regular 60-40 portfolio. Okay, so we're able to get better return and lower volatility through this diversification. So that's what it looks like. Now, there is a slide in here that I have missed that I need to show you guys. Just a second, if I can find it real quick. Well, enough of that here. Let me just talk a little bit about the. I'm just taking us back to where we were. So when we're talking about how do you achieve peace of mind and achieve great results for your or good results with your investments, you need to ask yourself some questions. And most people don't go into it thinking about this. So I just want to run through some of these. So one is, what is the purpose of your money? So it's important to keep this in mind, and it's especially for my clients who are retired. We have a whole drill about this because the purpose of your money is not just to have a big stash that you can call on as a rainy day fund. The point is, what are you trying to achieve once you're in retirement? Your money, just having a big bank account is meaningless, actually. It needs to produce distributions that help you accomplish the things that are important in your life. So it is important. And that's one of the questions we want to ask. Another one is, are you aware of the mental biases and blind spots that keep you from being a successful investor? We go into that in great detail. Are you invested in the market? Like I said, if you're not, if you on your financial assets, if you're a real estate guy and you know that, the less part of it, but you're going to have some financial assets, and those need to be invested in the stock market if you're going to succeed with them. Do you know the warning signs that you may be speculating with your money versus prudently investing? Well, we drill that today, right? What was it? It was stock picking, track record investing, and market timing, right? So I hope you've enjoyed this today. There's a lot of good questions to ask, and I'm sorry I lost other two. I must have worn them out. At any rate, Jimmy, I hope you're having a good day, and if you have questions, just pipe up and let me know.